Welcome back to Switzer on Australia's Business Channel. It's that time when we pick the brains of the intrinsic value guy, Roger Montgomery, the Chief Investment Officer of Montgomery Investment Manager. And apart from telling us what remains a good buy, he'll also evaluate the quote that bank stocks are good dividend yield buys. That's a controversial one.
I love the questions without notice.
Yeah.
They're the best ones.
Well, I thought you were the right guy. Yeah, a lot of people are saying.
Sure.
With bank dividends around 5 or 6 now, gross them up to about 8-ish or something like that. They're better than term deposits.
Yeah.
What would you say?
Okay, so I tell you how I've framed the answer. Good companies versus good yields, right?
Yeah.
So let's go back 5 years. We've got a company called Telstra. It's offering a yield.
You always pick on poor Telstra, but go on. Go on.
Well, we could use the banks. We could use the NAB, for example. But I've got Telstra, right?
Okay,
so
right,
Telstra's 7.4% yield.
Yep.
And another little telco company, much smaller, called M2 Telecommunications. It's on a 4.2%.
Who I taught, the founder and CEO.
You were his teacher.
Yeah,
right.
Exactly.
Vaughan Bowen.
Vaughan Bowen.
And it was on a yield of 4.2%, right? So you put $100 into Telstra, you get $7.40 in dividends 5 years ago, and you put $100 into telecommunications, you get $4.20. So everyone would say, well, Telstra's got a better yield. I'm going for the good yield,
Tick.
right? Better than a term deposit, which is what you just said. Here's what's happened since. The yield on Telstra is now about the same, roughly the same. But if you'd put $100 in Telstra 5 years ago, that $7.40 has now turned into about $5. And the capital value, your $100, has turned into about $84, $85. Right? So you lost 15%. Had you put that $100 into M2 Telecommunications, which had the less attractive yield, your $4, you would have got $4.20 back then. That yield has now risen to about $35, right? And your $100 has turned into about $1,100. Now, we could have done the same thing with a portfolio of stocks, and I've got them here.
Okay.
So if on the 30th of June 2007, we bought a portfolio of Telstra, NAB, Macquarie, Lend-Lease and Leighton's, we would have got a yield of 4.2% in 2007. If we'd bought a portfolio of Cochlear, Woolworths, CSL, Seek and Macmillan Shakespeare, some of the much lesser known companies, we would have got a yield of 2%. But here's the thing. Had we bought the first portfolio, we'd currently be down 50% and our dividends are lower. Had we bought the second one, we'd be up 28%, so we've outperformed by about 78% the other portfolio, the blue chip high yield portfolio. So there's two examples, an individual example and a portfolio example. So we don't care about the yield as much as we care about the prospects for the business. And what we want is a business that we believe in 5 years' time or 10 years' time is going to be significantly bigger, and we can buy it at cheaper than what it's worth today.
So how do you cope with like bad news in your life? Because
we get bad news.
Like Credit Corp was a bad news story for you once in your life, wasn't it? It didn't perform.
And then we bought it again, and it's been a great news story since then.
Okay. So I guess your answer is you don't put all your eggs in one basket.
No, you have to diversify a portfolio.
That's right, because one company can blow up on you, even though it's a good process.
But the Australian market is not very diversified. You know, the Australian index, the thing that everyone reports on, how much it went up and down during the day, it's basically resources and financials. Now,
and Telstra.
For the whole year, that's right. And for the whole year, we've been talking about how I think this run up in the iron ore price is a bit of a dead cat bounce, if you like, and I don't think the fundamentals are going to support a higher iron ore price. And what we've seen since the middle of February, we've seen BHP down about 16%, Rio's down about 24%, Fortescue Metals down about 30%, Newcrest Mining down about 26%. So they're crashes in anyone's language. That's a crash. And if the index went down 30%, that'd be a crash. So it's really important that we understand that if we're going to diversify, and if I borrow Peter Lynch's term here, we don't deworsify, right? It's really important that we're buying quality businesses, and that's what we're going to talk about tonight.
Exactly.
Some smaller businesses that are high quality.
Okay, and we'll take up the issue of whether banks today are a good buy for someone who wants to be in term deposits next time, all right?
Yeah, well, the term deposit... Okay, well, let's do it.
Because
let's do it in a fortnight.
It's a separate issue.
Stay on theme.
Okay, fine.
Okay.
So companies that fit the bill then, the sort of companies that you were saying in 5 years' time, I was sitting with Peter Switzer and I said, these are the companies you should be buying, not whatever. So what are they? Okay,
so there's a couple of companies at the moment. Now, I've been saying the market seems a bit expensive again for a few weeks now. And so we took some... I just want to give people some context here.
Yep.
We've taken some profit. We're about 35% cash in the Montgomery private fund.
Waiting for the pullback to buy again.
No, we didn't expect a pullback. I'm no good at predicting. I'm not smart enough to predict pullbacks. But the market seemed expensive because we couldn't find many things to buy.
Okay.
And even after the sell-off that we've seen over the last couple of days, we haven't found an increasing number of things to buy yet. So the sell-off hasn't produced value yet in the high quality space.
Okay.
Okay, so keep that in mind.
So you just haven't got a real lot of companies at the moment.
No.
And when we first started our specularly relationship number of years ago, there were lots, weren't there?
We went from 10% invested to about 90% invested, and now we're back to 65% invested.
Yep.
So we don't take the market as our cue. We take the prices of individual shares as our cue for when to take profits, because we compare them to value.
Yep,
Now, there's two companies here that we still think are good value.
Yep.
A lot of your viewers won't have heard of them before, so I need to spend a few minutes just explaining what they do. The first one is a little company called IMF. Now, IMF funds litigation in Australia. It has very little competition in the very large, high-profile class actions.
We've had the CEO on this program as well.
Delighted to hear it. That was Rob Ferguson?
Exactly.
Okay.
No, he's not CEO. He's
Chairman.
Yeah,
sorry.
Yeah.
So what these guys do is they give access to redress for people who individually couldn't afford to get their claim heard.
So they're class action
specialists, and they do a really great job of that. Now they've got 3 criteria that they use for selecting jobs, for selecting litigation. The basic criteria is claim size, needs to be big. Now I've heard some brokers say it's got to be more than $2 million. I think they're a bit bigger than that now. They need sort of $15 million plus. They need to have a very high likelihood of success, and we'll talk about how they get that in just a moment. And they need to assess the defendant's capacity to pay. So they've got to know that they've got some insurance and they can afford to pay the claim for the wrongdoing that they're alleged to have conducted. Okay, they run it like a funds management business. They have a team of 11 investment managers, and those investment managers are very, very good at what they do. In fact, I've got a very good friend who's one of the top barristers in Australia, really nice guy as well, and he told me he reckons they're really smart, these guys. So they're really smart guys.
They evaluate the likelihood of a victory.
Yeah, they have an investment committee. There has to be a unanimous decision to actually fund that particular action. So as a result of that process, they have a very high success rate. So since they listed in 2000, they've had 137 actions that they've funded. 80% of those, 93 of them, have been successful. A couple, I think 5, they haven't been successful, they've lost, and the majority of them they settle. So they do a really good job, and we think, and I'll summarise it this way, they're trading about $1.70 or $1.75 or thereabouts. We reckon they're worth probably $1 more than where they're trading. But you've got to remember, this is the sort of business, it's got $70 million of cash in the bank. It costs them $7 million a year in head office expenses to run the business. They need about $5 million a month of working capital, so they could easily fund themselves for a couple of years without any trouble at all. And what you've got to do is you've got to say, would I like to own a business where the money's in the bank, it's self-funding, and occasionally there's a big dividend check that comes to me?
Yep. Right? What kind of dividend yield at the moment?
I don't look at dividend yield,
I know,
so I couldn't tell you.
It's just like
but it's going to be extremely...
Just toss a check away.
It's going to be extremely chunky. No, we love the dividends when they come in, and we want them to grow. But I couldn't tell you what the yield is. I couldn't tell you what the PE ratio is either. I can tell you the intrinsic value. I estimate that it's worth about $2.60, $2.70. It's trading at about $1.70.
So certainly when they watch. Now we're running out of time. Any other company quickly?
The other one quickly to look at, you've got to get your head around this one, Silver Chef.
Now, your buddy on the program a couple of weeks ago did talk about it, but just add to it.
Yeah, okay, so Silver Chef, the reason why I like it is what it does, and the reason why we bring it up is we still think there's some value there. I don't want to bring up a different stock where there's no value, but some friends of mine at American Express.
They're all your buddies, aren't they? The barrister was a buddy, friends of American Express.
No, I have lots
inside information. No.
How do you get all the people, these great people on the show?
Exactly, buddies.
You know them.
Yeah.
All right, so American Express, some guys at American Express have said to me, look, what's been going really well over the last year is restaurants and cafes. And more recently, there's been a move down the price point in restaurants. So, but cafes have been going steadily since the GFC, whereas retailing elsewhere has been a disaster. It's just starting to pick up now. And so what Silver Chef do is they fund the equipment for the startup of cafes and so forth.
So they lease the whole stuff.
What people do when they look at Silver Chef, they say, oh, it's got too much debt. But it's a finance company. It's borrowing money to buy machinery, plant, which it then leases to cafes. And their default rate is very, very low, and they're expanding significantly. Their profits are up massively in the last half, over 40%. Their assets have grown by about 20%. And we still think that if you discount the debt, if you don't worry about the debt so much, and you're a little bit generous with your valuation, they still look okay.
So what's the share price and what is the intrinsic value?
Look, I think they're right on their intrinsic value now. So look up the share price. That's about their intrinsic value. But we think their intrinsic value is going to continue growing over the next few years.
All right, mate. Great to talk to you.
Okay, thanks, Peter.